Hey, Ken AG here. Welcome back. If this is your first time on the channel, we don't do hype here. We do math. Receipts over opinions, data over drama. Now we're talking about silver, and not in the way you usually hear about it. I'm not going to tell you silver is going to the moon. I'm going to show you why the system that prices silver is structurally incapable of telling you what silver is actually worth. And when that disconnect resolves, it won't be gradual, it will be violent. Let's get into it. Before we start, the standard disclaimer. Nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I'm walking through publicly available data and doing arithmetic. Now I want you to imagine a parking garage. It's got 500 spaces. Every morning, 600 people drive in expecting a spot. For a while, it works. People leave at different times. Spaces turn over. The garage never actually holds 600 cars at once, so nobody notices the math is broken. But one Tuesday, there's a concert downtown. Nobody leaves early. 600 cars show up, and there are 500 spaces. The first 500 drivers park normally. The last 100 circle the garage, honking, blocking exits, offering to pay triple for a spot. The garage didn't shrink. Demand didn't change overnight. The illusion just ran out of room. That is the silver market right now. The garage has been oversold for years, and the concert is starting. Let me show you the numbers. Global silver mine supply is roughly 830 to 900 million ounces per year. Add recycling, and total supply is about 1 billion ounces. Sounds like a lot. It's not, because on the demand side, industrial consumption alone hit a record 680 million ounces last year. That's not investment demand, that's not coins and bars, that's not jewelry. That's just industry eating silver and not giving it back. Solar panels, electric vehicles, 5G towers, medical devices, defense systems, semiconductors, data centers. Silver is the most electrically conductive metal on Earth. There is no substitute at scale that matches its performance. Engineering has looked, engineering has tried, engineering has failed. Now, add investment demand, jewelry, and silverware on top of that industrial base. Total demand exceeded 1.15 billion ounces last year against total supply of roughly 1 billion. That's a deficit of about 150 million ounces, 1 year. And here's the part that should make you sit up in your chair. This wasn't a one-time anomaly. This is the 5th consecutive year of structural deficit. 5 years running, the world has consumed more silver than it produces. The cumulative shortfall over those 5 years exceeds 670 million ounces. That's the equivalent of 10 months of global mine supply that has been consumed and not replaced. Gone, used, dissipated into billions of devices in microscopic quantities that will never be economically recovered. And this is where silver fundamentally diverges from gold. Gold accumulates. When a central bank buys gold, that gold still exists. It sits in a vault. It can be sold, lent, or revalued. The total above-ground gold stock only grows. It never shrinks. Silver is the opposite. Silver is consumed. It's destroyed in the act of using it. The silver in your phone, about 1/10 of a gram, will end up in a landfill. The silver paste in a solar panel is locked away for 25 to 30 years. The silver in a missile guidance chip is gone forever. Gold is a lake. Water flows in and the level rises. Silver is a river. It flows through and disappears downstream. The lake gets deeper. The river can run dry. And the river is running faster than ever. Consider just one sector: solar energy. Every photovoltaic cell requires silver paste to function. It's what conducts the electricity from the silicon wafer. Without silver, the panel is just expensive glass. The Silver Institute reported that solar consumed nearly 200 million ounces last year. That's almost a quarter of total mine supply dedicated to a single application. And here's what nobody predicted. As panels got more efficient, they started using more silver, not less. The older panels used a certain amount. The newer high-efficiency technologies, TOPCon and heterojunction cells, use 50 to 80% more per panel. The industry bet on thrifting. Physics said otherwise. Efficiency requires conductivity. Conductivity requires silver. But solar is just the appetizer. Electric vehicles 5G infrastructure, AI data centers, military applications, medical technology. Every sector that defines the 21st century economy runs on silver, and none of them have found a substitute. Not because they haven't looked, because silver's combination of electrical conductivity, thermal conductivity, and reflectivity is unmatched by any other element on the periodic table. That's not marketing, that's chemistry. Now let's talk about where the supply comes from, because this is where most people get the story wrong. They assume that if silver prices rise, miners will simply produce more. Supply will meet demand. Problem solved. Except silver doesn't work that way. Roughly 70% of global silver production comes as a byproduct of mining other metals, primarily copper, zinc, and lead. Silver miners don't mine silver. They mine copper, and silver happens to come along for the ride. This means silver supply is not controlled by the silver price. It's controlled by the copper price, the zinc price, global construction demand, and base metal economics. If the global economy slows and copper production contracts, silver supply contracts with it, even if silver demand is screaming higher. The supply curve doesn't bend towards you when you need it most. And the primary silver mines, the ones that actually target silver specifically, are in decline. The easy deposits were found decades ago. What remains is deeper, lower grade, and more expensive to extract. In 2005, a good silver mine processed ore with 15 ounces per ton. Today, a good mine runs at 4 ounces per ton. Same infrastructure, same diesel costs, same labor. 1/4 the silver. That means every ounce requires 4 times the effort it did 20 years ago. Mining is not a faucet you turn on when the price looks good. It's a decade-long process of exploration, permitting, financing, and construction. If you found a world-class deposit tomorrow morning, the first ounce wouldn't come out of the ground until somewhere around 2035. The market needs silver now. The mines deliver silver later. That gap is where the pressure builds. And now I need to talk about something that is rarely discussed honestly: the paper market. Silver's price is not primarily set by people buying physical bars. It's set on futures exchanges, where contracts representing millions of ounces trade every day. Most of these contracts never result in delivery. They're rolled, closed, or cash settled. The market functions as a pricing mechanism built on the assumption that physical metal is always available if someone actually wants it. That assumption works perfectly until it doesn't. Think of it like hotel overbooking. Airlines and hotels routinely sell more seats and rooms than they physically have. It works 98% of the time because enough people cancel or change plans. But when everyone shows up, the system breaks. Somebody isn't getting a room. And in silver, when everyone shows up means when industrial buyers and investors simultaneously want physical metal. We've already seen previews of this. In early 2021, during the first silver squeeze, COMEX registered inventories, the metal actually available for delivery, began dropping fast. Premiums on physical coins and bars exploded to 30, 40, even 60% above the spot price. The paper price said $28. The real price, the price you actually paid to hold an ounce in your hand, was $45. That disconnect lasted months, and that was a temporary, sentiment-driven event. Imagine what happens when the disconnect is structural. And let me be precise about why this matters. There are 2 prices for silver. There's the price on your screen, which is set by futures traders in New York and London, most of whom have never touched a silver bar in their lives. And there's the price in the real world, what it actually costs to buy a physical ounce and have it delivered to your door or your vault. In calm markets, those 2 prices are close enough that nobody cares about the difference. In stressed markets, they diverge. And the divergence is the signal. It's the market's way of telling you that the paper pricing mechanism has disconnected from physical reality. When your dealer is charging $45 and your screen says $28, your screen is lying. Your dealer is telling the truth because your dealer has to actually find the metal, buy it, ship it, and put it in your hands. The screen just needs a counterparty willing to take the other side of a bet. COMEX registered silver has dropped over 50% since February 2021. from roughly 152 million ounces to approximately 73 million. London vault inventories are near all-time lows, and a significant portion of what remains is allocated to ETFs, meaning it's legally spoken for. The available float, the metal that can actually respond to new demand, is shrinking quarter by quarter. The cushion is thinning, and thin cushions don't absorb shocks. They amplify them. Now here's where the story accelerates. The world has made a collective policy decision to electrify everything. Solar panels, electric vehicles, grid infrastructure, data centers for AI, 5G networks. This is not optional future demand. This is government-mandated demand backed by trillions in subsidies and legislation. Solar alone consumed nearly 200 million ounces of silver last year. That's roughly a quarter of total mine supply going into a single industry. And solar installations are not slowing down. They're doubling. China, Europe, the United States, India, every major economy is pushing renewables harder, not softer. And the next generation of solar cells, technologies called TOPCon and HJT, require 50 to 80% more silver per panel than the older technology. The industry predicted thrifting would reduce silver usage. The opposite happened. Higher efficiency demands more conductive pathways. More conductive pathways demand more silver. Then add electric vehicles. A traditional car uses about 15 to 20 grams of silver. An EV uses double that. But the next generation of EVs, especially those with solid-state batteries, could use between 500 grams and a full kilogram of silver per vehicle. Solid-state batteries need silver because it prevents dendrite formation, allows faster charging, and improves energy density. If even 20% of new EVs adopt this technology by 2028, you're looking at tens of millions of additional ounces of annual demand materializing on top of an already deficit market. Where does that silver come from? The mines can't ramp fast enough. Recycling recovers less than 20% of silver use because silver is dispersed in microscopic amounts across billions of devices. It costs more energy to extract than the silver is worth, so it goes to the landfill. Humanity is literally burying silver back into the earth in a form that's impossible to recover. There's a historical dimension to this that deserves attention. For most of recorded monetary history, silver traded at a ratio of somewhere between 12 to 1 and 20 to 1 relative to gold. That ratio reflected the relative scarcity of the two metals in the Earth's crust and their respective roles in commerce. Today, even with silver's recent strength, the ratio remains stretched far above those historical norms. When the ratio compresses, and it always does during periods of monetary stress, silver doesn't just outperform gold modestly. It outperforms dramatically. It overshoots. It moves with a violence that catches even experienced traders off guard. That's because silver's market is so small that when capital rotates in, there's nowhere for the price to hide. It has to move. And it has to move fast, because the available supply at any given price level is thin. Once that supply is absorbed, the next ounce costs more, and the one after that costs more still. Silver doesn't climb stairs. It takes elevators. And let's address the geopolitical layer, because it matters. Mexico produces roughly a quarter of the world's silver. The Mexican government has restricted new open-pit mining permits. Peru, another major producer, is plagued by strikes and political instability. Russia is sanctioned. China, the world's largest consumer of industrial silver, has been importing record quantities, while simultaneously restricting exports of refined metals. The countries that produce silver are making it harder to mine. The countries that consume silver are hoarding what they can get. That's a supply chain under geopolitical compression at the exact moment demand is accelerating. Let me bring this together with an analogy that I think captures the full picture. Imagine a small town with one well. The well produces enough water for the town most of the year. But the town is growing. New houses every month. A factory just opened. And the well doesn't get deeper just because more people showed up. For a while, the town draws down its reservoir, the water tower. But the water tower has a floor. And every month, the level drops a little more. The townspeople can see the water line falling, but nobody wants to be the one to say, we need to ration or find a new source, because that conversation is uncomfortable. So they keep drawing. And one dry August, when everyone runs their sprinklers on the same day, the taps go dry. Not because there's no water on Earth, but because there's no water in the tower. Silver's water tower is draining. 5 years of consecutive deficits. Inventories at multi-decade lows. Demand accelerating from structural, policy-driven forces. Supply constrained by geology, politics, and the byproduct trap. The math doesn't resolve gently. It resolves like the taps going dry. And here's the final piece that most analysts ignore entirely. Silver's market is tiny. The entire annual silver market is worth roughly $80 to $100 billion at current prices. That's smaller than a single mega-cap tech stock. It's a rounding error in the bond market. It's a few days of Federal Reserve balance sheet activity. That means small shifts in capital allocation have outsized effects. If 1% of global investment portfolios decided to take a position in physical silver, the available supply would be overwhelmed in days, not months. Silver's smallness is not a weakness. It's an accelerant. When capital finds a small market with limited supply and structural demand, it doesn't politely bid. It panics. It gaps. It creates the kind of moves that end up in textbooks. We saw this dynamic with nickel on the London Metal Exchange in 2022. Different metal, different fundamentals, same physics. When paper positioning and physical reality diverged too far, the price didn't correct gradually. It went vertical. The LME had to halt trading and cancel transactions. The market literally broke. Silver is not immune to that kind of event. In fact, silver's dual identity as both a monetary metal and an industrial necessity makes it more vulnerable, not less, because in a crisis, you don't get to choose which type of demand shows up. They both show up at the same time. Industrial buyers competing with investors for a shrinking pool of physical metal. That's not a market. That's an auction with no reserve price. I'm not here to tell you silver is going to a specific number. I don't do price targets, because price targets are just opinions dressed up in spreadsheets. What I'm telling you is that the structure of this market, the supply constraints, the demand acceleration, the inventory drawdowns, the paper to physical divergence, all of these forces are converging. And when they converge fully, the price doesn't walk, it runs. Not because of hype or YouTube thumbnails or Reddit threads. Because of arithmetic. Because you cannot consume more than you produce for 5 straight years and expect the 6th year to be calm. Silver doesn't need a narrative. It doesn't need a catalyst. It doesn't need anyone to believe in it. It just needs the math to keep doing what it's been doing. And the math has been remarkably consistent. Demand up, supply flat, inventories down, float shrinking. And somewhere on the horizon, a dry August is coming. The people who understand this are already moving. Central banks are accumulating. China is importing at record pace. Industrial users are locking in long-term supply contracts at premiums that would have been unthinkable 3 years ago. The smart money is not waiting for confirmation. The smart money is positioning before the confirmation arrives. Because once the taps go dry, the price doesn't just rise. The availability disappears. And you can't buy what doesn't exist at any price. If this video gave you a clearer picture of what's happening in the silver market, hit that like button. It takes 1 second, and it tells the algorithm to show this to more people who need to see it. Drop a comment below. Tell me where you think this goes. I read every comment, and this community teaches me as much as I teach it. If you're not subscribed, hit subscribe and turn on the bell. We're going deep on what happens to silver when gold reprices in the next video, and you're going to want to see those numbers. Share this with someone who's still sleeping on silver.